Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and we're certainly glad that everyone could join us today. We have a lot to go over. A lot has happened, but in a weird way, not a lot has happened. It's been very quiet since we did our last weekly update. The market and our strategies in particular are relatively flat week over week. So not really a whole lot has happened. And sometimes that's a good thing. You need to let things cool off, settle down before we make that next move higher. Now, the big message from this week's update is how the Federal Reserve is letting growth run hot. And what does that mean? That ultimately means that the Federal Reserve is looking at nominal growth. So in other words, the growth rate of the economy before we take out or subtract real growth, or subtract inflation off that top line growth number. And this is an important point because it ultimately impacts how we look at interest rates and how those interest rates impact overall asset allocation. So the three big messages from this week's update: the Federal Reserve wants to let nominal growth run, and that's ultimately going to lead to steeper yield curves, and steeper yield curves are good for the banks and they're good for energy. We can't be paying attention to the day-to-day. It's the number one mistake that clients make. It's the number one mistake that investors make, getting caught up on a data point that's reported and then how things move on that specific day. The last thing, energy, in our opinion, based on our research, based on the data, is the next big trade. So when we think of 2016 to 2020, our strategies led the country. Why? Because of our big trade in technology. Next is energy. We are very confident. We have done a lot of research into this space, and we really do think that this is going to be the big alpha generator when we look back 4 years from now. Energy is going to be a key contributor to outperformance relative to the S&P 500. So understanding the Fed's focus here a little bit. So over the last 30 years, the Federal Reserve's focus has been on inflation. So for those of you who lived through the 1970s, we certainly understand what inflation can do to an economy. We understand the pain that it can cause to consumers, and it was a huge cancer on the U.S. economy. And the Federal Reserve, led by Paul Volcker, initiated a war against inflation in the early 80s, and ultimately worked to kill off that excess inflation from 1980, 81, all the way through really to the 2010s. And it's been this philosophy at the Fed. But something has changed, and that's Jerome Powell. And with Jerome Powell, we're seeing a new Federal Reserve that their primary focus is not inflation, but it's actually on full employment. And what does that mean? That means that if inflation runs a little bit hot because they let nominal growth run hot, unless employment is full, they're going to tolerate a higher level of inflation. And we're not talking 6, 7, or 8% inflation. We're ultimately talking like that 3% level of inflation, which is structurally higher than it's been over the last 30 years. And they're doing that because right now the employment rate, not the unemployment rate, but the overall level of overall people that are working relative to the total size of the labor pool, is at its lowest level since the early 80s. There's still a lot of people that don't have jobs that were employed 2 years ago. And the Federal Reserve is intent and focused on getting those people back on the payroll. So what does that ultimately mean? That means lower rates for longer on the short end of the curve. So that federal policy rate will be longer than expected on the short end of the curve, which will drive nominal growth higher and will drive those 10-year or long-term interest rates higher, ultimately leading to a steeper yield curve. And that impacts how we look at overall asset allocation. We also see that playing out in the actual data. We went through this last week, but Whether we're talking about ISM manufacturing, new orders, employment, supplier deliveries, business inventories, what we see here is an accelerating rate of change when it comes to all the various inputs into economic growth. So when the rate of change is going up, and when we see short-term rates anchored and long-term rates allowed to float, we want to sell those US dollars. We want to buy commodities. We want to buy stuff priced in US dollars that will benefit from a falling US dollar. And we want to buy the banks, right? Those are the areas of the market that historically outperform when we're going into an environment where nominal growth is the focus, not necessarily inflation control. So what does this all mean? So we broke this down here for everyone. We want to invest in assets that benefit quite simply from higher nominal growth. When the Fed focuses on employment, those short-term rates are going to be low. That leads to higher nominal growth. Higher nominal growth leads to higher long-term interest rates. That's good for energy, financials, materials, industrials, and select areas of the consumer. So that's how we're looking at the overall framework. And we know that the economy is healthy because of the data. When we look at the inventories are bare bone, when the shelves are empty. And when inventories are this lean, ladies and gentlemen, what this ultimately means is that it just takes a smaller demand of consumption by the consumer to force businesses to restock those inventories. We get those traditional recessions when inventories are elevated. There's no need to place more orders with their suppliers. And ultimately, if those sales don't come through, we destock those inventories, and that leads to a contraction in economic growth. So what we see here on this chart on the left is the new orders plus backlogs minus inventories. So in other words, the higher that number is, the less inventories there are. And we see that inventories are bare boned. Now, as it relates to the overall market, which is why we're here, why we invest in the market, we want to make some money. We look here, volatility relative to the high yield credit default swap market. What we see here is the credit markets, the level of credit risk premia priced into the market continues to fall. In other words, that perceived balance sheet risk within credit markets is falling. It's costing less for companies to borrow money relative to the federal government. Volatility hasn't caught up yet. At some point, volatility will catch up to what the high yield credit markets are doing. And if the VIX continues to fall, that risk premia in the stock market falls, and stock prices tend to go upward when that is the case. What we see here on the chart on the right, the advanced decline line is breaking out to the upside. There are more advancing stocks than declining stocks. When we string that along a data series and we accumulate that over time, we're seeing that breakout upward and to the right. So why do we like energy? We keep talking about energy this, energy that. Why do we like it? It comes down to three simple reasons, ladies and gentlemen. There is a massive pickup in global energy consumption right now. It's a V-shaped recovery in the US, Europe, Japan, China. Now India is starting to reopen. All of these key consumers of oil, and we do use a lot of oil still, are massively picking up their consumption rates. Second, there is a lack of supply response. The overall rig count in the US is barely flat. It's recovered a touch, but nowhere. It's still 60, 70% below the 2019 levels. And of course, the third is that no one owns energy. That's where you ultimately make big returns, is when the fundamentals are improving, you get a good technical backdrop, so bottoms have been put in from a price perspective, and the valuations are attractive. And lastly, no one owns it. There is money to flow into that sector that can push prices higher. The fundamentals can be great, but if you have no money flowing into the sector, who cares, right? You need someone to actually come in and buy those assets. And of course, it's going up a wall of worry, right? The crowders, and we used this slide last week, no one uses oil anymore. I've heard many people say this, obviously a ridiculous statement, but a measure of the sentiment that we see out there as it relates to energy. Energy's in a 13-year bear market. Used to be double digits of the S&P 500. Now it's around 2.5% weight. Energy at less than 3% is less important than Tesla or Apple as it relates to overall asset allocation, how it impacts the move of the S&P 500. So these are very, very key points. The bar has been set very low to positively surprise to the upside. Meanwhile, what we actually see in the backdrop of that negative sentiment is an oil price that touched $70 this week. Kathy Wood, the Epic growth manager, said oil will never hit $70. That was 2 weeks ago. It's $70, right? So that just kind of shows you, beware what the media and talking heads say. Never is a dangerous word, right? We hit that $70 level. Oil is up 9% off of where we were in 2019. The energy index is still down 7%. Oil service index down 10%, right? So these are key points. But when we look at that 10-year numbers, right? Those 10-year numbers are way below the record highs. And when we look at what's happening relative to the S&P 500, we're seeing big breakouts in both the energy and the oil service index. Prices are trying to tell us a story that we don't hear in the media. And the last time we had $80 oil, ladies and gentlemen, this OIH index was over $600 $600 a unit, or on the index price. The ETF is $600, over $600 a share. Sitting way down here, ladies and gentlemen. So there is a lot of upside. If everything plays out, these indexes, these sectors can double from here. Now, obviously that has to play out, and we should, focus on going up first, and then we'll see what happens after that. But there is a lot of upside to this sector if the fundamentals continue to improve the way that they are so far. And then, of course, Wall Street's always slow to respond. We always hear about, well, what do the banks saying? What are the analysts saying? But the problem is the market prices stuff ahead of where analysts are. There's literally only one analyst that has $70 oil in their price decks. When we look at their research, their assumptions of oil, only one. We're at 70 right now. So guess what that means? If all the analysts in their assumptions have $60, $50, $55 oil, guess what they have to do to their price targets at $70? They got to jack up those price targets, right? That's how modeling works on Wall Street. They're slow, but if you can get ahead of the curve and you know how the game works, you can anticipate where those price target increases are going to take place. Just today, RBC lifted its price point on oil from $66 to $70.50. And guess what its 2022 assumption is? $75. Ladies and gentlemen, if everything plays out to the way we think it'll play out, oil will be at $100 in our opinion. So these price projections are going to be continually adjusted higher. And that's going to impact the price targets, and that's going to be good for the stock prices. I love this chart. ExxonMobil is removed from the Dow. Literally, that was the bottom. That was the bottom for the energy sector. We look at the XLE, the day that ExxonMobil was taken out of the Dow. When you see stuff on the front pages, when you see everyone saying that everything is bad, and when you look at the data and you see things improving, that's opportunity, right? That's how we want to invest. We want to be lonely investors, not popular investors. And of course, the credit markets remain rock solid here as we wrap up today's weekly update. And again, we would want to see some level of spread widening out. We want to see that contagion being reflected in the credit markets before we got negative on the stock market, because right now there's no real need to be that negative on the stock market. So overall, higher nominal growth means higher long-term rates. Energy, banks, and consumer and industrials tend to benefit in this type of environment. That's where the portfolios are overweight right now. Does that mean we're going to outperform today or tomorrow? I have no idea. But over the next month, 2 months, 3 months, I think the portfolios are very well positioned to do well in this sort of environment. And of course, no one owns energy, and it's combined with an improving fundamental backdrop. That's what gets us excited as investors. So overall, thank you again to everyone for tuning in. And if you have any questions whatsoever, please reach out to your advisor, or you can reach out to our home office here at 888-543-3776. Thank you for your business. And of course, have a great week and weekend. And we'll see you again next week.